Today, we're demystifying a topic that's absolutely vital for any successful organization: managerial accounting. Now, what exactly is it? Well, well, think of managerial accounting as the company's internal GPS. It's the secret weapon for making smart internal decisions. Unlike its cousin, financial accounting, which is all about creating reports for outsiders like investors and regulators, managerial accounting is purely for the team inside. It provides managers with timely, relevant, and future-focused data. We're talking about the information needed to guide resource allocation, steer strategic planning, and make the best choices for the company's future. The best part? It doesn't have to follow strict external rules like GAAP or IFRS. Its only job is to help managers run the business better, day in and day out. It's flexible, it's forward-looking, and it's all about giving leaders the insights they need to navigate the complexities of the business landscape. Now, let's get into one of the core concepts you absolutely need to grasp: cost behavior. Understanding how costs behave is fundamental to everything else in managerial accounting. Generally, we classify costs into two main categories: variable and fixed. It's a simple but powerful distinction. Variable costs are costs that change in total as your activity volume changes. A classic example is the cost of raw materials for a manufacturing company. The more units you produce, the more materials you need, and the higher your total material cost will be. On the other hand, fixed costs are the ones that stay constant, regardless of how much you produce or sell, at least within a certain range. Think of things like the monthly rent for your factory or office, or even the CEO's annual salary. These costs don't fluctuate with production levels. Why is this so important? Because analyzing this behavior is essential for so many critical tasks, like creating accurate budgets, setting the right prices for your products, and performing that all-important break-even analysis. As a manager, you have to know which costs you can actually influence and which are set in stone, as this knowledge directly impacts your ability to control profitability. CVP analysis is built directly on that knowledge of fixed and variable costs. It allows you to examine the intricate relationship between your sales volume, your total costs, and most importantly, your profit. The cornerstone of CVP is finding the break-even point. This is the magic number, the point where your total revenues exactly equal your total costs, meaning you're not making a profit, but you're not losing money either. It's the baseline for survival. Managers use CVP analysis for so much more than just breaking even. It helps them answer crucial questions like, how many units do we need to sell to avoid a loss? Or what will our profit be if we sell 10,000 units instead of 8,000? It's also invaluable for making strategic decisions about pricing changes or shifts in production. Should we lower the price to sell more? What happens if our variable costs go up? CVP is the primary way to model the financial impact of these operational changes before you commit to them, giving you a clear picture of the potential outcomes. Another critical function of managerial accounting is budgeting and performance evaluation. This is where the strategic plan gets real. Budgeting is the process of translating an organization's high-level goals into a detailed financial plan for a specific period. But a budget is so much more than just a plan. It's also a powerful control mechanism. It sets clear benchmarks and expectations. Once the period is over, the real work begins. We compare the actual results against the budgeted figures in a process called performance evaluation. The differences between what was planned and what actually happened are called variances. Managers then analyze these variances, both good and bad, to pinpoint problems, identify unexpected efficiencies, and understand what drove the results. Was our revenue lower because we sold fewer units or because we had to offer discounts? Did our costs go up because materials were more expensive or because of production inefficiencies? This constant feedback loop of planning, measuring, and analyzing is absolutely vital for driving continuous improvement, fostering accountability across all departments, and ensuring everyone is working towards the same financial objectives. So, to wrap it all up, managerial accounting is a dynamic, integrated system of reporting and analysis, designed specifically to serve the internal needs of management. It's not about ticking boxes for compliance. It's about providing the right information at the right time to the right people so they can make the best possible decisions. Understanding these core principles, from cost behavior and CVP analysis to budgeting and performance evaluation, empowers managers to move beyond guesswork. It enables them to make informed, data-driven decisions that directly maximize profitability and operational efficiency. In many ways, managerial accounting is the engine room of a well-run, successful business, quietly powering progress and steering the ship toward its goals. Thanks so much for tuning in today. I hope this gives you a clear picture of what managerial accounting is all about. If you found this helpful, please give this video a thumbs up, and don't forget to subscribe to the channel for more content just like this. See you in the next one.